you wonder how an investor with let's just say 10,000 US dollars, with 10,000 US dollars account can control 10,000 units of euros at a euro-dollar exchange rate of 1.10, which should obviously cost the trader 11,000. So let's just say that you have an account of $10,000 and you want to buy 10,000 units of euro US dollar at a rate of 1.10. That would cost you $11,000. That would cost you $11,000, but you only have $10,000 in your account. Okay, so welcome to the world of leverage. Okay, leverage is a double-edged sword. You need to understand that as well. Now, if you use leverage correctly with a degree of, cautiousness and proper understanding of the inherited risk that it carries, then you should perceive the ability to make the use of leverage accounts as a benefit to control larger lots. Okay, and that's how we can control 11,000 US dollars worth of 10,000 units of euro dollar with only a 10,000 US dollar account. Okay, now for the experienced traders, leverage definitely serves the purpose of exploiting one's strategy to maximize returns without the need to put down as deposit the total amount transacted. Okay, now you should also see leverage as the brokerage lending you money, with the trader or the investor only need to put down, as I said, a relatively smaller good faith deposit. Okay, however, and that's where the risk really lies. You must understand that the more units of a particular currency that you're going to be buying or selling, the more your account will be hit by the change of every pip against you. By the same token, it can also increase your gains. But it must be emphasized that what really matters here in Forex is to limit the downside risk. That's the whole purpose of proper risk management. Limit the downside risk. So following the example that I just demonstrated to you in the prior slide, if you let's just say that you choose to trade with a leverage of 100 to 1. Okay, so what it means is that the broker will only require a deposit of, so initially we were supposed to spend 11,000 US dollars to own 10,000 units of euro US dollar. But since we are using 100 to 1 leverage, then we only gonna need 11,000 US dollars multiplied by 1%. 1% is 1 divided by 100, which is the 100 to 1 leverage. Therefore, we only gonna need 110 US dollars to control 10,000 units. Okay, that's how a $10,000 account can control a much larger size. Okay, just don't ever forget that if your account goes through a severe drawdown and the capital in your account is not enough to cover the losses currently incurred due to the excessive lot sizes that you are trading, you're going to run the risk of getting a margin call. That's, at the end of the day, a margin call by a brokerage will occur when the account value, your account value, is not sufficient to meet the broker's minimum value required. Okay, when a margin call happens, the broker's internal risk mitigation system is going to be kicking in, and that's what's known as a margin call event, whereby all positions will automatically be closed and trading will no longer be allowed until the trader deposits again more funds, so that the margin account is brought up to the minimum maintenance margin. Okay, so for you to understand, remember that leverage will allow you to control a bigger size of your account, but at the same time, you will be exposed, if you don't control your risk, to margin calls if you cannot meet the minimal requirements.